Hello, smart people. How are you today? I am recovering from spending 2 days at the JP Morgan Tech Investor Conference in London. I don't know why conferences are so tiring. It's literally in the same city I live in. Anyway, in this episode, I want to share lessons that are useful for founders from this big investor conference. So let me tell you what it is first and why it's useful for you to know what's talked about at events like this. So when an investment bank puts together an event like this, it's because they want to be the bank that companies choose when they list on the stock exchange, or if they do mergers and acquisitions, which is basically when one company buys another company, or when a company is going to raise money from private investors. So basically, a bank like JP Morgan or Goldman Sachs, they would make money if a company like, say, Revolut decides to go public, as in list their shares in the stock exchange, or buy another company, or do another private fundraise. And so if they do that and they use JP Morgan as their bankers, JP Morgan would make loads of money. And so they're very happy about it. That's why they have these events. So in general, the people presenting at the conferences, they're the founders and the hired leadership teams of tech companies that are fairly late stage. Because if you're not really like that close to doing a major transaction, the investment banker is not going to put you in front of public markets investors. And the audience, they're basically what I just said, they're public markets investors. So they are people from pension funds or hedge funds or family offices, or just basically some very rich people who would just invest as a very wealthy individual. And so the aim of these events is for the investors in the audience to get to know the companies and their leadership teams. So when a company like Revolut announces their IPO, the investors already know the business and they already want to invest. And if there's demand, then that means that the share price at the listing would be high, which would make the founders and the venture capitalists and basically anybody who's got equity rich. And so that would make them happy. Anyway, investment banks do these conferences for all sorts of sectors. And I went to the one on the tech sector earlier this week. So you might be an earlier stage founder. Maybe you're just working on your first idea. Or maybe you already have a team and you have a working product, but you are nowhere near IPO. So you're thinking, well, should I skip this episode? Well, no, don't. Because whatever business you run, you're operating in a wider context. AI is everywhere, but companies now are mostly using it as a cost-cutting measure, not something that's driving growth or really big innovation, with some exceptions. So AI came up on every single panel, like literally every company leader, every founder was asked, okay, how has AI changed your business? And they all, well, actually, no, the majority, not all, said the same thing. AI has been a fantastic tool for internal productivity, for automation, for customer service, and basically for cutting costs in our internal systems. But it's not yet something where we are really creating new products that are AI products, and we're not really yet unlocking massive revenue streams with it just yet. So this AI hype, it was definitely there, but investors are now, really asking about the numbers. So how does investment in AI really affect the money? And this reminds me of the crypto blockchain hype that we had a few years ago. I mean, it's still here, but not as crazy it was a few years ago. And so Jamie Dimon, the CEO of JP Morgan, he was at the conference and he talked, he was asked about Bitcoin and blockchain. And he said that he is not interested in Bitcoin, as in the actual coin, and he's not investing in it, and he doesn't see it as a real asset. But he says that JP Morgan is investing in blockchain because there are genuine use cases for blockchain. And this is a really good reminder, basically, for you not to give into the hype and for you to focus on a specific problem, because blockchain has problems that it solves. Bitcoin, well, Jamie Dimon was saying that the problems that it solves are not problems that he wants to be involved in, basically, dodgy people sending money to each other. So let's get back to AI. AI. AI is getting all the buzz, but just like blockchain, it only creates value when it solves a real problem. So, as a founder, ask yourself, where is the friction in my product? What's slowing down my team? What's confusing my users? Where is there friction? And can I use AI as a solution? Is AI the best solution? Because you don't really want to be trend hopping. So basically, don't chase trends, invest in infrastructure. That's what Jamie Dimon is doing. That solves a real problem. I saw that investors kept on asking about your total addressable market, which basically is the TAM. So if you hear people talking about the TAM, that's your total addressable market. And it's interesting that essentially they were asking, how do you, as a leader, as a founder, how do you think about TAM? Which shows that the founder is the one who's leading the investors, not the other way around. So the investors are not saying, this is what I think your market size is. It's the founder who is saying, this is what our market size is. And obviously, every single founder was like, our market size is massive. Anyway, this reminds me of a conversation I had with the CEO of a publicly listed company. And he literally said to me, equity analysts think what you tell them to think. So basically, that means that you, as the founder, you need to have the knowledge and the confidence to lead that conversation with them, not to have it be led by them. Because if it's led by them, it's probably not going to be to your advantage. So, my advice for you is don't just Google a market size stat. Don't just use ChatGPT and paste it into your deck if you're speaking to investors. Learn how to build your own TAM, like learn how to build that your own logic. So go from bottom up, which is how many users are there, what's going to be the price, and that's going to be your market share. But do not spend ages on this because honestly, in the early stages, calculating your TAM, it's kind of a business school exercise. Like, yeah, it's interesting to do, but it's all very, very theoretical. Generally, in the earlier stages, you're not having the same detailed discussions about TAM as you do in the later stages. The main point that I want you to see from this is that you, as the innovator, as the leader, it's up to you to be the expert in your space because just as much as equity analysts and equity investors need to essentially be led in how big the market is, it is the same with private capital. So if you don't lead the story, somebody else will, and that will make you poorer. Investors want to be led, so lead them. I noticed that the founders on stage outperformed the hired execs by miles. I mean, it was really, really, really remarkable. So at this conference, some of the companies were represented by the founders, and other times they were represented by people from their board or their leadership team, like maybe the chief financial officer or the chairman. And I just noticed that the founders were higher caliber. They shared the most interesting insights. They were more interesting to listen to. They tended to be better storytellers. They also really knew their company and their industry as if it was their own body part. I mean, really, it was very interesting to listen to them because they were more knowledgeable and, frankly, more charismatic. But don't think that this is something that they were just born with, because, if you're going to be the chairman of a company that's about to IPO, you're also really clever, right? So, in terms of natural abilities, they all probably had the same starting line. But to be a founder who is presenting to a bunch of public markets investors on the stage at JP Morgan, you need to have gone through so much hell. You need to have gone through multiple rounds of fundraising, which is never fun. You need to have spoken to lots of press. You might have had some bad press. You have definitely had lots of failure, probably co-founder drama. You've definitely had a lot of like horrible drama. And you somehow got through it. You chose to learn from it rather than let it get you down. So that charisma, that knowledge, that confidence that these people have, it comes from basically overcoming really, really unpleasant situations. And, it comes from years and even decades of hard work. So basically, the founders put in more work and suffer more than everybody else. And when you actually see them on the stage, it shows because, they are higher caliber, like they are higher performers because they've suffered more. So my advice to you here is to practice your presentation and storytelling skills, because honestly, the people, the best founders, the founders there, they were really good presenters, they were really good storytellers, and don't think, oh yes, it's a soft skill and I can just wing it. Like, these people had clearly gone through a lot of practice to get there. But also just know that when the proverbial poo hits the fan, that's the thing that actually gives you that confidence to speak, to essentially be a better performer on this like very, very high performer stage in the first place.